Good evening, everyone. Welcome to our LA Homebuyer Workshop. My name is Jason Meda. I'm going to be your host for this evening. Super excited to bring this content to you. Tonight's session is going to be very interactive, so we encourage questions as we roll through to tonight's content. You can go ahead and use your chat function in Zoom, and then I'll answer some of those questions on air, so we can kind of get a chance to share that information with the rest of the group. We know we get a chance to teach these workshops about every other week or so through our different partnerships and just some of the communities that we serve throughout California. This workshop is designed to help you on the path towards homeownership. So you're going to learn a lot of different tools, resources that are available to you as first-time buyers to kind of help you on that path. And there's so much going on in today's market, obviously economically, what's going on with interest rates, the housing market. So hopefully there'll be one, two, maybe three things that you'll get a chance to take away from tonight's discussion. A little bit about me. I'm a branch manager with American Pacific Mortgage. We get a chance to serve our communities in homeownership. We specialize in first-time homebuyer programs here with our team. So tonight you're going to learn a little bit about the CalHFA assistance program designed to support first-time homebuyers with down payment and closing cost resources. We'll talk about a bunch of other products tonight, but that's some of the core stuff that we'll focus on this evening. Let me show you just really quickly our talking points for tonight. So we're going to look at the housing market, as I just mentioned. That'll include interest rates, what the housing market's doing right now. I think tonight's a really good opportunity now to kind of really assess what is going on with the housing market and for you to be a little bit more informed as a consumer as to what's happening in the market. And I'll kind of give you some scenarios as what we're experiencing today as we work one-on-one with our clients. We're going to do a budget analysis in just a few minutes where we're going to kind of do a rent versus buy scenario where we're kind of look at if I continue to rent versus what it'll look like if I buy. What can that look like for me in home ownership? I'll speak to you a little bit about credit, how to optimize our credit for our upcoming home purchase. We'll also look at student loans and maybe how those can change your qualifying. We'll also look at loan programs and the different options that are available to you as a buyer. We'll look at some of the documentation also that's required to get prepared for home buying. And then, as I mentioned earlier, we do specialize in first-time homebuyer programs. So we're going to talk a little bit about down payment assistance program offered through CalHFA, which is the California Housing Finance Agency. Many of you might have even heard about our workshops and some of the things that we do to help our community and homeownership through CalHFA. And then finally, we'll talk a little bit about the process of buying a house. What does it look like to be pre-approved to purchase my home and go through those different milestones and experiences as I already get to the finish line to get the keys to my house. And we'll talk a little bit about consultations tonight. That's where we get a chance to do a one-on-one with you to design a home buying plan and to get you on that path towards home ownership. And so we'll kind of spend some time tonight looking at that as well. And like I said earlier, we encourage you to kind of interact with us as we move through tonight's workshop. So if you do have any questions, please feel free to send me a chat. And then I'll go ahead and answer those questions as best as I can on air. But we'll also carve out some time at the end of tonight's workshop to be able to discuss anything that was left behind. Okay, so let's go ahead and dive in. As we think about home buying, it's probably going to be one of the largest investments that you and I make in our lifetime, right? It gives us the opportunity to create stability in our housing budget. Obviously, with the cost of everything rising so quickly now with this high inflationary environment, being able to control our expenses for the future is a big deal. You have the ability to, this is an asset. So you have the ability to create this asset and create wealth through this asset. And that's called home equity. And that's when you look at the amount that you own your house versus what your house is worth. That difference is also known as home equity. And especially over the last 2-3 years, as we went through this pandemic, many of our first-time home buyers have seen just these huge amounts of equity levels just by the rise in the market. And finally, there's some great tax benefits that still come with buying a home. Even though we had some tax changes in 2018, there's still some great opportunities to get tax savings also with home ownership. Now, as I mentioned, I want to kind of take you through a budget analysis as we launch into tonight's workshop, just because as we're kind of starting home ownership, budgeting is a big thing. We want to figure out, where are we currently at from a rent perspective, and then what's it going to look like for buying? It's very difficult, especially in today's market, to be able to have rent that's going to be equivalent to what I'm going to buy. So we're going to have to maybe design a budget that's going to allow us to be able to get into the market with maybe an increased amount of outgoing obligation in our housing budget, but we need to understand what that's going to look like for us. So I'm going to create a scenario for us as we move through tonight's content. And by the way, all the material that I go through this evening, we're going to go ahead and send the slide deck to you tomorrow morning. Okay, so you can get a chance to go through and kind of go through your own budget analysis yourself. I'd encourage you to try to take some notes tonight as we go through tonight's slides, and then certainly as we roll through the content. If you do have any questions, let's go ahead and talk about those on air. So let's go ahead and plug in just a scenario here. I'm going to go kind of work through this together with you guys. So if we plug in, let's say $3,000 a month in rent, let's assume renter's insurance of $15 a month. Let's also assume that our rent's going to go up. Let's just say 3% per year. I know many of you that are getting ready to maybe sign new lease agreements, you probably might see an even larger increase, but let's put 3% for tonight's discussion. And then for purchase price of home, I know this is also going to vary based upon where many of you live perhaps in Southern California, but I'm going to put 600,000 right now. And I know for some of you that might be a condo or a townhouse. Others of you, it might be a single family home. But let's plug in 600,000 just kind of as a baseline for home ownership. Okay. And then we're going to go ahead and put our down payment amount. So we're going to have 3% in this scenario. The minimum down payment to buy a house is 3% for a conventional loan, 3.5% for an FHA loan. We're going to add property taxes. Generally, when qualifying for a mortgage, we're going to use about 1.25% of the sales price for our property taxes. So we're going to put $7,250 in for this discussion. We're going to assume homeowners insurance, maybe about $1,000 a year. We want to carve out a budget for maintenance. I'm going to increase that a little bit to like $1,500 a month. And then around assumptions for loan information. So we're going to plug in a 30-year fixed mortgage. For most of our first-time buyers, we're going to be looking at 30-year fixed mortgage products. We're going to talk about interest rates in just a minute, what that looks like for you. Interest rate wise, we're going to put in 6.875 for now. We've seen interest rates right around that 6.8 level to as high as 7% as of late. Origination charges, that's what your lender is going to charge you for your financing. Okay, and so that's what that'll look like. So ultimately, or mostly, I should say, lenders are going to have a processing fee, an underwriting fee, and there'll be some kind of miscellaneous fees. For our team here with American Pacific Mortgage, we have a $910 processing fee and a $995 underwriting fee. So if we kind of plug those numbers in here, what's that like $1,905? Now, for our clients that are part of some of our partnerships, whether you're a state employee, maybe you're a USC alum, for example, we do have a discounted closing cost program that allows you to save up to $750 in your closing costs. Now, the next section is called discount points, and especially in a high rate environment, this could be a strategy that could work for some of our buyers, which allows you to bring down your interest rate by increasing your costs. And that's called discount points. Usually discount points of say 1%, so it'd be 1% of your loan amount, will bring down your interest rate about 0.25%. Okay, so for tonight's discussion, I'm going to leave that empty. And then we'll have settlement charges, which are also known as closing costs. Generally, closing costs in total between lender costs, some of your government charges, title and escrow, those will usually be anywhere between 2 to 3% of your sales price. And then the other assumptions we want to make, we also want to plug in appreciation for our home. So hopefully over time, the home will go up in maybe 3 to 5% appreciation rates. And then we're going to plan on being in the house for 7 years, we'll say. This next section is called the selling costs. Not usually, but when you sell a home, you're going to have costs of selling the house. For realtor representation, closing costs, we're going to budget that at about 10% of our sales price. Now, as a buyer in working with a realtor, fees are paid for by the seller. So when you sell your home eventually, and so like our scenario is 7 years from now, you're going to be paying those same realtor fees, but as a buyer, you're not responsible for paying those costs. We're also going to factor in state and federal taxes and then the savings rate. So what this budget comes back to us, it says, okay, if we continue to rent for the next 7 years at $3,000 a month, and then it increases 3% per year, we are going to pay back $267,000 in rent, okay, with no kind of return on that investment, right? But if I look at possibly buying over the next 7 years, when I factor in equity appreciation, tax benefits, that asset that's growing for me, I potentially have an opportunity of about $40,000 over 7 years. Now, that being said, you're going to jump from $3,000 a month to closer to $5,200 a month. So I mentioned earlier, it's a lot more expensive to purchase, but at the same time, there's an opportunity to obviously create equity for yourself. And of course, this is an asset that, as we see here, that's growing over time. Now, budgeting and or more entering the market and having a budget like this is not for everyone. I think that's why it's really important for all of you that are joining tonight's discussion to really figure out, does it make sense for me to enter the market at the current climate? And, for many of our clients, it does, but for others, it may not be exactly the right time. And, like everything in real estate, things will cycle, housing market cycles, interest rate cycles. And so I think that's, as we look at the opportunity in the market, we're going to just have to make sure that we've done all kind of our discovery work to make sure that we're in a great position to purchase when that time comes. Now, I think the opportunity that presents itself right now is kind of what's going on with home prices. I think for many of you that are, watching homes on Zillow or Redfin or Trulia, some of those different sites, many of you are probably seeing price reductions right now that are coming. Maybe you had your eye on that $600,000 condo in Long Beach, and now all of a sudden it just cut $35,000 in price. Well, that's not really uncommon right now. We're seeing that really across all markets that we serve currently. And so I think that's where there's an opportunity for our first-time buyers, especially. If I look back, maybe 3 or 4 months ago, and some of our buyers that were trying to enter a hyper-competitive market, interest rates were still in a moderate position, but it was really difficult to get into the market because prices were so high, and there's still a very competitive climate. But that's really cooled off, and it's really forced sellers who now have homes that are lingering on the market for 2, 3, maybe 4 weeks to face price cuts. And I think that's where first-time buyers especially have an opportunity to get into this market. When we look at the cycles of the real estate market, I think it's more important to get into a lower priced home than potentially the optimal lowest rate, because at the end of the day, you do have opportunities with the cycles of interest rate to potentially take advantage of refinancing, in the future. Now, that being said, if you look at the last 2.5 years that we faced in the market during the pandemic, we had all-time interest rate lows, right? And so many of our clients, consumers in the marketplace were refinancing to take advantage of rates as low as 2.5 or 2.6. And so, that's really unprecedented times. Will that come about at some point again? Not sure. Hopefully there's no other, pandemic in the future that we have to endure as a country. But at the end of the day, rates will cycle lower. It's just a question of when. So I think really the opportunity for first-time buyers is, does it make sense for me to get in the market now? And can I create a budget for myself given today's interest rate climate? So let's talk a little bit about interest rates, and I like to kind of show you where interest rates have gone. I mentioned to you the interest rate lows were about 2.6. We saw those in latter part of 20. And then you can see kind of interest rates stayed in that high 2s level, kind of started moving upwards into the 3s. We hit the 4s in the first quarter of 22, and then we really saw just a really quick move upward in interest rates. And just this last month, we've seen interest rates hit their not all-time highs, but the highest we've seen in the last 2 decades. So hitting 7%. So that's obviously a big kind of, a visual to see 7%, rate, especially coming from the 2.6 world that we were used to, not that long ago. So I think, when we're looking at interest rates, hopefully we'll start to see a little bit of a flattening in interest rates. There is some concerns that as a country, we're kind of on the verge of recession if we're not already in one. And some signs are pointing to that we are maybe in a recession because of the inverted yield curve with short-term and long-term rates intersecting. You can see there's not a huge gap when you look at the difference right now between where the 5-year or 5-year fixed mortgage is, as well as the long-term rate of a 30-year fixed mortgage. So that could tend to lead to a potential recession. So generally in a recession, we'll see kind of, more consumers moving their money into the real estate market. That could maybe stabilize real estate prices, and we'll see interest rates go down. But I think the challenge for us as maybe first-time buyers is, does that create more competition and then a rising price environment? So those are things that we'll kind of have to see how the market, shifts out here over the next 2, 3, 4 or 5 months here. And certainly it'll be interesting to see what's in store for us. Now, as we look at interest rates aren't just a set number for every buyer. Interest rates will be dependent upon a few things. One is credit eligibility. Generally, when I have a 740 credit score or higher, I'm going to be able to take advantage of the lowest available interest rates. Loan product wise will also change the opportunity for my interest rate. So whether it's an FHA loan, maybe a conventional loan, that could change my interest rate offering. How much I finance, how much I put down. So whether I put 3% down, which is just the minimum on a conventional loan, or I put 30% down, that could change my interest rate offering. The cost that I want to pay in what we call discount points, which we covered that a little bit earlier today. The opportunity to be able to lower the cost of my interest rate by increasing my costs, that could potentially help, reduce my interest rate, but again, increase costs. And then different terms that we use for our mortgages. So the term that we set our loan at. So usually we're going to take advantage of a 30-year fixed mortgage, but let's say maybe my budget could afford maybe a 20-year fixed mortgage or a 15, maybe even a 10-year fixed mortgage. That can help also lower my interest rate options. It's our job that as we meet with you one-on-one for a consultation to design home buying options that fit your budget. And so that's where we'll get an opportunity to do that during a consultation and see what interest rate option works best for you. Okay. I think we had a question. Do you want to grab? Okay. I thought we had an attendee raising a hand. So, okay. So let's talk a little bit about credit. As you just heard, credit will impact your financing options for when it comes to interest rate. Now, every loan product has different credit minimums. For an FHA loan, the minimum credit score is 580. Conventional loans, so that's maybe a Fannie Mae or Freddie Mac loan, 620 credit score. For our veterans loans, our VA loans, it's a minimum of 620. And then for some of the first-time buyer programs, minimum credit score of 640 for an FHA loan, 680 for a conventional loan. Okay, and you're going to learn a little bit more about CalHFA loans in just a bit. I want to talk to you really briefly about what goes into FICO score calculation. Now, for all of our guests tonight, I'm sure you probably have some type of monitoring system when it comes to your credit, whether that's offered through Credit Karma, Experian, TransUnion, maybe even Equifax. And the scores that you receive from those credit monitoring services are generally a credit card score. Now, for obviously applying for a home financing, that is the mortgage score that we're going to utilize. And so this is kind of the weighting of a credit score. And so when we look at the FICO model, it's 15% is going to be how long I've had credit. So the longer I've had credit, the more mature my credit file is, the higher my score could potentially be. 20% is going to be how much new credit I'm putting in use. So how many new credits in my accounts am I trying to establish? But it's more importantly like inquiries. Usually hard inquiries will impact your credit score. Now, when you apply for a mortgage, maybe an auto loan, you have a 30-day window of time to apply with as many lenders as you want to, and that's the equivalent of one credit inquiry hit to your score. Now, as you start our process with our team here, we do start with a soft credit score to go through your consultation. So it limits that impact to your credit score, especially if you're looking for a long-term game plan. So because a lot of our clients maybe aren't ready to buy right now in the next couple months. Maybe it's like a next year type goal. So I think the soft credit inquiry really helps with that planning. 30% is going to be how much credit you had owed and also that's known as credit utilization. Credit utilization is the difference in credit limits versus your credit balances. So if I have a $10,000 credit limit and I have $5,000 in balances, I'm at 50% utilization. And that's usually the aggregate of all of your credit card balances and or lines of credit, like personal lines of credit, overdraft protection, things of that nature. We would really encourage you, if you're running 70, 80% utilization, try your best to get that utilization below 50%. If you've already mastered that and you're really in the habit of keeping your balances pretty low, try to get your utilization below 10%. That's going to really help optimize your credit score. The last component to the FICO weighting is going to be payment history. Obviously, that's pretty self-explanatory, but the way FICO scores, the credit report is set up with the days of delinquency, it goes 30-day late, 60-day, and then 90+ delinquencies. Obviously, the more severe you're late, the more impact to your credit score, especially in the last 12 to 24 months. So the more recent challenges you've had on your credit report in the last couple of years, that's going to be the most impactful to your credit score. So if you missed a student loan payment 4 years ago, it's probably not going to be as impacting as a student loan payment you just missed 6 months ago. Okay, one of the tips I like to give our clients or our attendees that hopefully are one day our clients in our sessions here is just around managing credit utilization. And this is kind of what I do for my credit cards is that if you look at your credit card statements, you have a billing cycle date. You also have a due date for the credit card. Now, the date of the billing cycle is when your credit card issuer is going to send out that balance information to the credit reporting agencies. So all three of them, TransUnion, Equifax, and Experian. A great tip to manage credit card balances, especially if you're trying to maximize your credit score, is to try to pay down those balances before the end of your billing cycle date. So if you owe $5,000 on that, Visa with B of A, and the cycle date is today, the 18th, but you have a due date on the 30th, you want to try to pay it off today before that billing cycle date ends, because then you're going to have a lower utilization because that balance has come down, and hopefully, like I said, raise your credit score. Okay. A couple other things to think about when it comes to credit score factors with late payments like bankruptcies, short sales, collections. Those are going to be a little more impactful to your credit score. We're going to show you a matrix on kind of how long those will stay with you in just a second in the next slide. And then account closure can be impactful to your credit because you want to make sure that, especially your long-standing accounts that you have, try not to close out those accounts. And we're speaking specifically of revolving accounts, because the longer we can keep those accounts open, the better your credit score could be. And when it comes to lending, like I mentioned, we look at 3 different credit agencies. So Experian, Equifax, and TransUnion. We always take the middle score of those 3 bureaus. So if I'm at 720 is my top score, 700 is my middle, and then let's say 680 is my lowest, 700 is the score we're going to use for qualifying purposes. Now, if I'm applying with a partner and my partner's at 760, 740, and 720, well, my partner has a 740 credit score. But even though my partner score is higher than my middle score, we still take the 700 credit score when it comes to qualifying. Okay. Any questions on the credit side here? Okay, this is that matrix I wanted to share with you, just kind of how long late payments or maybe really past challenges will play with you, be part of your credit report. The hard inquiries is probably the biggest thing, but when we look at hard inquiries, those most recent 6 to 12 months are probably going to be the most, kind of have the most effect on your credit report. Student loans are something that, we're generally talking to most of our clients about, because a lot of our clients, especially as our first-time buyers, have, student loan debt. We do realize that, with some of the Biden administration changes we're seeing with student loan forgiveness, and those are set, I think, to roll out in the next 30 to 60 days. That's all great, and those will help reduce those balances. Until those balances come down, we still have to count the existing balance against our clients for qualifying. But there's a couple different approaches to qualifying with student loans. If you're going to be qualifying with an FHA loan, we have one formula we look at. If it's a conventional loan, it's another. If you're in an income-based repayment amount, so let's say you have $75,000 worth of student loan debt, and your income-based repayment amount was $250 prior to the pandemic, because all of our federal loans are in forbearance right now because of the CARES Act. But if that $250 payment was what I had prior to the pandemic, then that's what we're going to be using for qualifying. Now, if you never set up an income-based repayment amount, the default is going to be 0.5% of the balance for an FHA loan, 1% for a conventional loan. If you have a zero payment, because that's what it's been because, of your income-based repayment amount, then zero is the amount we'll use. But really, for student loans, we do have to qualify with some type of payment. even if you're back in school currently and now your payments are deferred, as a lender, we'll still have to add some type of minimum monthly payment for your qualifying. So that's something we'll talk through as part of a consultation with you, because when we design a home buying plan for you, we also look at your monthly obligations. And we're going to talk more about debt to income ratio later on tonight, but the student loans will get factored into a debt to income ratio. Okay, I think we had a question that came in earlier about conventional loans and FHA loans. What's the difference? So hopefully this information now will kind of answer some of those questions that you had. So these are kind of 5 of the core products that we use in serving our home buyers. Most of them are going to be utilizing the conventional and FHA loans, but some of our clients are veterans that need, the VA loan that can help them in financing. And that's a great resource for our clients. But other clients, we'll be looking at the USDA product, which the USDA loan is going to be helping clients that are buying in more remote areas. Let's say you're going to look to buy in Pollock Pines here in Northern California, or maybe you're looking at a desert community that's in a rural area. The USDA loan helps with those areas. And usually it's a no down payment option. Same holds true with VA loans. So if you're VA eligible because you're a veteran that has served, there's no minimum down payment requirement. The other product here shown on the screen is called a jumbo loan, and those are for our clients who are going to buy and need financing above 970, 800. Usually it requires 10 to 15% down payment, so it's a lot larger than that 3% we talked about earlier. But with jumbo loans, there's a characteristic that's pretty important because it requires a little bit more assets, not just from a down payment and closing cost perspective, but it also requires additional assets for what we call as reserves. Reserves are assets that I have left behind after I've contributed my down payment and my closing costs. Usually the reserve requirement is 12 months, the equivalent of my monthly payment. So let's say I have a $6,000 mortgage payment for my jumbo loan, and then it's a 12-month requirement. That means I need $72,000 in additional assets on top of my down payment and my closing costs. So 12 times 6,000 would get you the 72,000. That can take 401k as reserves, 403bs, obviously checking savings accounts, brokerage accounts. But that's kind of one of the main characteristics of jumbo loans. Now, most of our first-time buyers are going to be electing either a conventional loan or an FHA loan. So let's kind of dive into those 2 products and look and see how they can help you in home ownership. Now, conventional loans have a minimum credit score of 620. Financing all the way up to $715,000 has a minimum down payment of 3%. Now, once we go over 715 in loan amount for LA County or even Orange County, if you're joining us from Northern California, it'd be some of our Bay Area markets. But once you go over 715,000, the down payment jumps from 3% to 5%. And that goes all the way up to a loan amount of 970, 800. And so the space between 715 and 970, 800 is called the high balance loan limit. So for some of our high cost of living areas like LA or Orange, Ventura, San Diego, those are gonna have an option to go beyond a 715 loan amount, but it has that increased down payment. FHA loans, they're gonna go all the way up to 970, 800 for most counties. If you're in San Bernardino, if you're in Riverside County, it's gonna be capped at 715. But the minimum down payment is going to be 3.5%, whatever loan level you're at. With FHA loans, it has a much lower credit score requirement at 580. And we're going to talk about mortgage insurance in just a bit, because that's really kind of the key differentiation between conventional and FHA loans. Now, when you put less than 20% down, you do have a thing called mortgage insurance. And for those of you that are doing your searches on Redfin or Zillow or Trulia, you're probably running some payment calculators, which is great. So you can get a sense of what budgets look like. Generally, what I find is most of those calculators don't have really a very true calculation of mortgage insurance. Because when we look at mortgage insurance, it factors in kind of 3 characteristics. It looks at your credit score, it looks at your down payment, but also considers your amount financed. And so when we do our calculations as a lender for you, the better your credit score is, the more you put down, the less you finance, the less you're going to pay in mortgage insurance. And there's different ways to pay mortgage insurance. You can pay it on a monthly basis. You can split it between a monthly payment and then also pay for some of it up front. You can pay for all of it up front. That's called a single premium mortgage insurance. And then there's lender paid mortgage insurance. And what we do with that is we take and we kind of increase the interest rate to create enough revenue in the financing instrument to pay off or buy out the mortgage insurance. That's not really going to happen in this kind of a market right now because interest rates are obviously so high as it is. More often than not, most clients are going to utilize monthly mortgage insurance. And monthly mortgage insurance potentially allows you to cancel your mortgage insurance once you have 2 years in your home and 20 to 22% equity. And so many of our clients that have seen massive appreciation and they've been in the house for at least 2 years are now looking at potentially canceling their mortgage insurance versus having to look at maybe refinancing to exit their mortgage insurance. If we look at conventional PMI, and let's just take this example down here at the bottom of the screen. If we finance $450,000 and let's say we have PMI, we have a credit score of 740 and 3% down payment, our PMI is about $183 a month. If you probably ran that same scenario in some of the Zillow and Redfin calculators, you'll probably come up with $250, maybe $300 a month. So it is obviously advantageous to have a higher credit score and put a little bit more money down because then you will see that lower mortgage insurance premium. With FHA loans, it's a little bit different because it's a monthly MI premium of 0.85% of your loan amount, regardless of where your credit score is at. So whether I have a 620 credit score, if I'm a 720 score, I still have the same monthly premium with FHA loans. Now, there's two components to mortgage insurance with FHA loans. There's monthly, but there's also upfront. So there's the 0.85% monthly, plus we have to add on upfront mortgage insurance, which is 1.75% of our loan amount. Now, you do have to retain mortgage insurance for the full 30 years if you're only putting 3.5% down on an FHA loan. The only way to exit mortgage insurance is if you refinance out of FHA into a conventional loan. Now, FHA does allow you to terminate mortgage insurance if you put 10% down or more on an FHA loan. However, most clients utilizing FHA are not going to put that amount of money down for their purchase. Let's look at an example of PMI now on an FHA loan. So we take that same 450 loan amount. We're going to have monthly, and we'll have the same credit score. Now we have monthly PMI of 324 and 32 cents plus the upfront PMI of 78.75. So, obviously there's about $140 difference in monthly PMI, but we've also had to add on the upfront mortgage insurance, which increases that amount financed closer to $458,000. So if we're doing a kind of a side-by-side comparison, you may kind of step back and say, well, why would I ever choose FHA? Because it sounds like there's some downside to it with the MI and the way it's structured. And I think there's a few things to kind of take away from that. One is, conventional loans and FHA loans have different guidelines and different restrictions for buyers. So FHA is going to be a little more lenient for our clients. As you can see, FICO scores are lower, 580 versus 620. FHA will have a little less or a lesser seasoning period for a client that's had a bankruptcy. So if you had a bankruptcy 2 years ago, FHA will finance you right away. Conventional would have you wait for 4 years. If you've had a few maybe late payments in the last 2 years, maybe 12 months, FHA would probably be a better solution versus conventional might be, a little bit more difficult to qualify. So different factors like that may have our clients, may help. We may want to design more of an FHA financing over conventional or vice versa, depending on kind of where you're at from a credit perspective. Okay. So that gives you an idea of what mortgage insurance looks like for home buying, but it's really our job as we design that home buying plan to figure out what product works best for you. Okay, I know we had that question earlier on products. Hopefully that answered your question for you. Any questions I can help answer as we move into some of the documentation required to take those next steps in home buying? Okay, all right. We'll keep it moving then. So let's talk about qualifying income and some of the documentation and maybe some of the misconceptions that we do here in working with our clients throughout the years when it comes to verifying maybe some of their current income. Now for the documentation, if you're a W-2 wage earner, it's really pretty easy. We'll generally need the last 2 years of W-2s, your last 30 days of pay stubs, then we'll have to verify your employment. Usually it's in a written form as well as a verbal form. Now for our self-employed individuals, it's a little bit more extensive because it depends on how your taxes are structured. Usually if you're sole proprietor, we're going to need to see the last 2 years of taxes, Schedule Cs, profit and loss statement, balance sheets, and then we'll have to verify the business. And that's usually from a CPA letter, maybe like through a website with the Secretary of State here in California. We can verify the start of the business information. If you're incorporated, it'll look a little bit different. Usually with incorporated, or incorporated businesses will have 1120s and different tax records that we'll have to gather. So that might look a little bit different. Usually, if you're self-employed, we're going to have to see 2 years minimum of work history since the business has been open, to be able to kind of show just consistency in earnings from the business. So usually we'll average the last 2 years for our self-employed clients. Now, for our W-2 wage earners, usually we need to see at least 2 years of work history and/or education. Doesn't necessarily mean that you have to be on the job 2 years. We just have to at least see 2 years of work history. So, or education. So what that would look like, let's say, I know we're in the fall right now, but let's say I just graduated in spring with an accounting degree, right? And I just started my job in September. Now I'm only 2 months on the job, but if I got my degree in accounting and now I'm working for an accounting firm, I had 4 years of undergrad, plus I got my new job. So I have more than 2 years history, and that would satisfy the employment requirement. So that's a question that kind of comes up quite a bit for our new first-time buyers. The other thing that comes up is job transition. So if I've switched to a new job, do I have to be on that new job a certain amount of time before I'm eligible for financing? And the answer is no, because as long as I've started my job or I have an accepted offer letter, as long as I can put together either that 2-year work history or the 2 years history, including maybe education, then I'll meet those requirements. Okay, so I think this question kind of goes right in line with what I just was talking about. But question came in: if I've changed jobs within the past 2 years, should I get verification for my old job and my new jobs? So the answer is yes. But you wouldn't have to do that verification. We'll actually take care of it. So as we process your loan, eventually when you have an accepted offer, we verify the work history for the last 2 years. So we'll verify your current job as well as all your previous employers. Okay. Good question. Now, for part-time employment, you do have to show you've been with that employer for 2 years to count part-time employment. If you have dual employment, so let's say I'm in the healthcare industry and I work 30 hours at one clinic, 20 hours at another, we do have to show that we're working on both jobs simultaneously for the last 2 years. Now, some of our clients are maybe upcoming graduates in maybe the fall semester, and they're looking to start jobs at the first of the year. We can qualify you off an offer letter, so that's something that's allowed in financing. The way the rule works is we can qualify you with an offer letter. You have to start your job before your home closes, and you have to get your first paycheck before your first mortgage payment is due on the new financing. Okay. All right, so that's a little bit about just the income side of things. Now I want to still stay with income, and I talked a little bit about debt to income ratio, and that's where we look at monthly obligations versus your pre-tax income. So it's a calculation that all lenders use. Usually we want to see that debt to income ratio, so your monthly obligations versus your income, to be no more than like 43 to 45%. There's exceptions to go up as high as 50%. That's allowed in the industry. But when we look at designing home buying plans, we want to make sure we probably try to stay as close to that 43 to 45% level as much as possible. Most of our first-time buyers feel comfortable around 33 to 36% of their gross monthly income going out to expenses. But it really just depends on your situation. It's really important for us to design a home buying strategy that's going to keep that affordability in line for you. We certainly, as expensive as things are today, we want to make sure that we're designing a home buying plan that's going to be sustainable for you and affordable long term. Now, when we look at debt to income ratio, here's how that calculation works. So we take into consideration the principal and interest, the taxes and the insurance on the house. We also take PMI into consideration. And if you're buying a condo, maybe a townhouse, we're going to factor in HOA or homeowners association dues. So if we have a client that's spending $2,500 a month for that particular property, and they have, let's say, $500 in other debts, that means I have $3,000 in outgoing debts, and I have pre-tax income of $8,500. So if I was to look at that debt to income ratio, I'm going to be about 35.29%. That's right, kind of in that sweet spot of 33 to 36%. But like I said, it depends on everybody's situation in looking at their different home buying strategies. Okay, so that's debt to income ratio. You feel free to go ahead and work on that yourself at home, but we'll actually put that together for you as part of your consultation and show you what that looks like. Now, the next and last component of home buying is going to be savings for my assets for down payment and closing costs. And this is probably one of the most difficult aspects for most of our first-time buyers. And we're going to talk to you about a solution in just a minute with first-time buyer assistance programs that can help maybe fill the void where maybe there's some challenges for you in savings. But nonetheless, when we look at verifiable assets, we're going to need to verify your checking and savings account for the last 2 months. Cash deposits are usually not acceptable. We have to paper trail every deposit that's coming into the accounts, for financing. If there's a large deposit, let's say you just got a tax return, obviously we can paper trail that, or, maybe you had a payroll that was a big bonus. Those are all traceable, but just cash deposits are not allowed in financing. Retirement accounts can potentially be used, 401ks, 403bs, IRAs. Usually with 401ks and 403bs, you're going to take a loan out against the asset and then utilize the funds that way. IRAs, you could create a tax event. So we always encourage you, talk to your tax advisor, your financial advisor, make sure you're making a smart financial move before accessing those retirement accounts. And gift funds can be something that's used as well, in combination with maybe your funds. That's where a family member is helping support you with your down payment and closing costs. Now, there is no seasoning requirement for gifts. Those can be transferred to you right away, but it can't just be in cash. We usually have to trace those funds through a gift letter, bank statement to see the transition of funds. And then if it's being sent straight to what we call as escrow, there's usually some type of trail of wire receipt for those funds. Okay, so as I mentioned, assets and kind of just having enough savings, especially in today's market, can be really challenging for a lot of our buyers. Usually when I meet with clients and, we're getting ready for our consultation, there's kind of two challenges that face us. It's either, like I said, assets, or it's just credit challenges. Maybe we're overextended, or maybe we've had a few, kind of challenges with our late payments or anything like that. But, I think when it comes to savings and having enough money for home buying, assistance programs can be a fantastic resource to help you in achieving home ownership, maybe a lot sooner than you may think. We're proud to be the #1 partner for CalHFA, which is the California Housing Finance Agency, designed to help low and moderate income households, really take on home ownership and be successful in home ownership. And I'm going to talk to you about CalHFA programs in just a second. And just I'm going to answer one question really quick because it'll be a quick one. We had an audience member ask, do you have to have a savings account? Answer is no. You will have to have at least a checking account, some type of banking relationship for financing. Okay. All right. So let's talk a little bit about assistance programs. And we're going to categorize this into low income housing products, and we also have moderate income housing products. And the first program we're going to talk about is called the Equity Builder Program, which is designed to help low-income housing clients. Those are clients that make less than 80% of the median income, which provides up to 10% of your sales price in assistance. As long as you stay in the property for 5 years, the assistance is completely forgiven. We're going to talk to you a little bit more about that in just a second. For our moderate income household clients, there's the My Home Assistance Program that provides 3% on a conventional loan assistance. So it's 3% of your sales price, 3.5% of the sales price for a FHA loan. Now that's moderate income. So that allows us to go up to much higher income limits, in the 160 range for some of our clients in LA County, up to 200,000 in Orange County. Now, the next section is a product that's kind of under construction right now. In fact, I was part of a kind of a committee for CalHFA today. I was on a call with others that are helping kind of build this next program called California Dream for All. Just at a high level, I'll tell you a little bit about it. It's designed to help moderate income household buyers. It's set to launch in Q1 of 2023, so we're not too far away from that. And it allows you to get up to 20% of your sales price in assistance. It's not forgivable, but you don't have to pay back until you either sell the home or if you refinance in the future. But it also has another component. It's called an equity share, and that's why we're kind of putting the finishing touches on that, which is you're sharing with the state in the equity appreciation of up to 20%. Now, what that means for you as a buyer is if your home goes up, let's say $100,000 over the next 5 years, if you sell the home in 5 years, then you would not only pay back the 20% that you got from the state, but 20% of your equity back to the state. Now, the opportunity is to be able to get into a home with a lot less money down than you normally would and have much lower payments, because obviously 20% down eliminates mortgage insurance, and creates just less financing for you. But the trade-off is, the repayment and then of course the equity share. But I think this will be a really fantastic product for Californians as this gets a chance to roll out, especially because it just includes a lot more of our clients, especially at those moderate income levels. So here's what the income limits look like on these programs right now. So for our low income housing clients, the Equity Builder program is a solution right now. Here's the limits for our Southern California markets that you can see here. Now, I will tell you the Equity Builder Fund right now has limited funds. We expect the funds to run out on this program in the next 90, maybe 120 days, depends on how many transactions occur. There's about $21 million left in the fund for Equity Builder. And then once those funds are eliminated or reduced down to nothing, then we're going to transition and hopefully into the California Dream for All product. And that's on the moderate income side. So you can see the income limits here. It's 180 for LA County, 235 for Orange County. So these are just much higher limits than we typically see on most first-time buyer programs. Most of our local communities, like say the city of LA or LA County, may have local community products, but those are really usually capped at 80% of the area median income. Now, the forgivable equity program, as I mentioned, it's 10% of the sales price or appraised value, whichever is less. What happens is those funds are completely forgiven after 5 years. At year 1, 20% of it's forgiven, year 2, another 20%, and so on and so forth. So if I sold my house in year 4, then I will only have 4/5 of the assistance to pay back to the state. So 20% of that assistance will be paid back to the state. And it allows you to combine the assistance from the state with other funds that you have, maybe gift funds. You can put up to 20% down of your own funds and then add in the 10%. So a maximum total down of 30%. Now, this program cannot be combined with other CalHFA programs, unfortunately, but in helping so many clients across the state with this program, those that qualify, it's a fantastic solution to achieve homeownership. Here's a quick little scenario that you can kind of check out for an example of a $500,000 purchase. Traditionally, if I was buying a $500,000 house, I'd have a 3% down payment. And then, like I mentioned earlier, closing costs will be anywhere between 2 to 3% of your purchase price. So normally I need about $25,000 to $30,000 out of pocket to purchase. But if I was to buy the same house and now I'm eligible for the Equity Builder assistance, now I could put maybe 7% down. So I'm putting a lot larger down payment, lower mortgage insurance, less amount finance, and then I can take maybe the other 3% and pay for my closing costs. So now I have a much lesser amount out of pocket and, of course, hopefully a more affordable payment for ourselves. All right, the next product is the moderate income product, which is My Home Assistance. I've talked to you a little bit about it earlier, but I'll just give you a quick little, a few other details here. It is a low interest loan at 1%. It's simple interest, and it's not required to be paid back until you either sell the home or if you refinance in the future. Now, there's also closing cost assistance called ZIP assistance, but we're going to table that one for right now because right now in today's market, that program's not available because the market is so volatile from an interest rate perspective. So currently we just have the My Home Assistance, but hopefully as maybe interest rates kind of drift down a little bit, at some point we'll see that ZIP assistance be reinstated. So let's apply the My Home Assistance to our same $500,000 scenario. We know that we need about $25,000 to $30,000 out of pocket traditionally. Now I take the same scenario and let's say I have a My Home Assistance of $15,000. Essentially what that's going to do is that's going to help satisfy my $15,000 minimum down payment requirement. And then now instead of having to worry about $25,000 to $30,000 out of pocket, maybe I'm somewhere around $10,000 to $15,000 out of pocket. And certainly that's a lot more attainable for many of our first-time home buyers. Now, there is some eligibility requirements, as you heard earlier. There's a minimum credit score of 640 for the FHA loan, 680 for the conventional loan. The maximum debt to income ratio is 45%, but if you're at a 700 credit score or higher, you actually can go up to a 50% debt to income ratio on the program. And really why that's important is because the income qualifications, we actually look at just the applicant, not the entire household income. So why that's important is that if I just apply just in my name, let's say, and I make $100,000 a year, but my spouse makes $150,000 a year, and with our combined income, we're over the threshold for the income limits. If I can qualify in just my income, that's the only income that we're going to look at from a qualifying perspective. Now, a first-time buyer is someone that hasn't owned in the last 3 years. So if you owned in 2015 and now you've been renting for the last 5, 6, 7 years, you are now considered a first-time home buyer. And this program works for single-family homes, new construction, condos, townhouses, even some of our below-market homes that are offered throughout California. Manufactured homes are eligible. The only thing that's a little bit challenging with the product on those particular homes is they have to be on land that's owned. It cannot be like in a mobile home park or basically land that's leased, which is in essence what happens with mobile parks. Okay, questions about first-time buyer programs. Okay, I think I got a question come in. So a question came in, and this is a great one because it's really fitting given the current state of the market. Is it possible to ask for a credit towards closing costs so the My Home Assistance would cover the entire down payment at a higher percentage? So yes, it is. And that's a great question. So let me explain to you what a seller credit is. A seller credit is where you negotiate with a seller for a certain price of the home, but within that negotiation say, hey, okay, seller, I'm agreeing to buy this house for $500,000, but I do want a credit of $10,000 to go towards my closing costs. And in that scenario, that $10,000 can help offset your closing costs, or like we talked about earlier, perhaps you can utilize that $10,000 to even buy down your rate even lower. Okay. And I'm glad you asked the question because that is happening more and more. And that's why in this market right now, it's a buyer's market, and which is so much more opportunistic for first-time buyers because now you can negotiate those seller credits, which like I said, 3 or 4 months ago, that wasn't something that was even possible. Next question was, if I'm already own a home, but it was gifted to me and I never bought a home, would I qualify for first-time home buyer assistance? So good question. So the way the first-time home buyer requirement is if you have lived in that house that you were gifted the last 3 years, then you're not considered a first-time buyer. But if you were gifted that home, you're on the deed and you've lived in the house, then you're let's see, sorry, let me back up. So if you were gifted that house, you're on the deed, but you've never lived in that house, then you're still considered a first-time buyer. But if you were gifted the house and you've lived in there in the last 3 years, then you would not be considered a first-time buyer. Okay, good questions. All right. And if you guys need me to go back and talk a little bit more about those first-time buyer programs, I'm more than happy to do that. I want to now talk a bit about the buying process because this is pretty important. And that this is a really good visual tool to help you kind of see where do I go from pre-approval all the way to step 6 and getting the keys to my house. We call that closing the loan. And we're very happy that, we've helped several clients this week close their home loans and really excited to help families welcome them to their new homes. And the pre-approval is the starting process for the 6 steps of home buying. It is the output of a consultation with us. And like I mentioned earlier, and you'll hear it again in just a bit, a consultation is a one-on-one with me that I help design a home buying plan for you and just figure out a budget and interest rate and overall design. And the output is a pre-approval. The pre-approval is a certificate that you present to a seller that says that you're eligible for your financing. It's usually valid for 60 days, but if it takes you longer to find your home, we can always recertify that pre-approval at any time. That's not a problem at all. And we'll customize that pre-approval based upon your financing needs. Now, the next step is house hunting. That's where you get a chance to kind of do your online search. Maybe you connect with a realtor. Hopefully you do, because realtors are going to be a really great advocate for you and a resource in the market to help not only find the right house, but negotiate with a seller. We have a fantastic network of preferred realtors that we work with that are really skilled in the first-time buyer programs that we can always connect you with. But you're always encouraged to use a realtor or find a realtor on your own. But I think that's a really great resource to have in the buying process. Now, if you find that house that you love and you make an offer, maybe you negotiate a seller credit like we just talked about in just a bit or just a second ago, then when you come to terms with that seller, you have a ratified agreement or accepted contract. Now you're going to enter escrow. That means the seller has accepted your offer. Usually the timeline from acceptance of offer to getting your keys is about 30 days. It can be as short as 21 days, but the standard rule of thumb is about 30 days in the industry. Once the offer has been accepted, you'll be required to make an earnest money deposit. That's kind of a good faith deposit. I'll share with you a little bit more about that in just a second, but it's usually 1 to 2% of your sales price, and it's required to be made to the escrow company within 2 to 3 days of the accepted offer. Now, within 24 hours or less from the accepted offer, we're going to give you a call to congratulate you on your acceptance. talk a little bit about next steps with you, and then schedule you for your follow-up video consultation where we get a chance to go through all your financing design with you. And then what also happens simultaneously is your realtor is ordering inspections on your house. We're going to order an appraisal of the property. Now, after we've completed your follow-up consultation, we're going to send disclosures to you that highlights the interest rate. We'll have your rate locked in by that time. You'll know kind of what your out-of-pocket expense looks like for your financing. Now, the question came in just now about the earnest money deposit. Is that paid using our down payment money? So great question. I'm glad you asked that question. So the earnest money deposit does not come from your assistance. The assistance is not funded until the very end of the process. So you are required to have that amount of money out of pocket. Like I said, it's usually 1 to 2% of your purchase price. That money does, however, count towards your total out of pocket. And the earnest money deposit is protected while you're in escrow through the contingency period. And the contingency period allows you to do your due diligence on the property. The contingency is usually a timeline from anywhere between 14 to 17 days, allows you to get your house appraised. You're going to get your house inspected. And then, of course, you're going to get your loan approved. So your deposit generally is protected during that time frame. Now, 3-4 months ago, super hyper competitive market. It was really tough to even get contingency, especially in the Southern California market. But then again, things have switched. Now it's more of a buyer's market. So now you can get all the time you need to do your homework on the property. Make sure this is a sound investment for you. So, and again, I think that's where this presents a much better opportunity for our first-time buyers. Step 4 is going to be processing and underwriting. That's where our team verifies your employment, your assets, kind of gets everything structured for your financing. And of course, your rate is locked in by that time. We really encourage our clients to lock in our rates sooner than later because it is a volatile market. One little bit of economic news can come out and can really change interest rates. So that's really important process or important step to take. The underwriter will now review the loan and issue a loan approval, which moves us to step 5. Once the underwriter has issued that approval, our team will reach out to you for some of the conditions of the approval. That's pretty customary in financing. At that time, you're also going to be at the end of your loan contingency. So if you're comfortable with obviously how your financing is structured and the outcome of your inspections, your appraisal, then you're going to go ahead and remove that contingency. That tells the seller that you're comfortable in the kind of the work you've done and you're ready to move forward to the final stages of the process. And as part of those final stages, we're going to issue to you a final closing disclosure. It's going to give you a 3-day cooling off period before you can sign your final loan documents. So some of our clients that got their closing disclosure on Monday will now be eligible to sign final loan documents on Thursday. Step 6 is the very final stage, and that's where the signing of the loan documents happens. That takes about an hour, maybe an hour and a half to go through that process. At that time, you'll see all your your interest rate and all the options of your financing that won't look any different than what you've seen in previous disclosures. You'll also see your final cash out of pocket, which also will be shown on your closing disclosure. So those numbers should be relatively the same. You'll wire in the final funds for your home financing after you've completed that signing. That money gets collected by the escrow officer. They'll also receive the funds that we wire in for the first mortgage, as well as any assistance programs that you're using. After that money gets balanced and everything's accounted for, so the seller's receiving the funds they're expecting, you're contributing what you're supposed to as a buyer. Once that is all balanced out, the escrow team will record documents with the local county recorder's office. They record a grant deed that transfers ownership to you. They also record a deed of trust, which is your agreement to repay the loan. So after all those things get confirmed as recorded, then you become the official owner of the home. And now it's official, and you get a chance to get connected with your realtor, go meet them at the house, and hopefully get a chance to move into your home as quick as possible. And it's a huge accomplishment. Throughout that process, there's a lot of anxiety, frustration, stress, but we try to make it and try to help manage that as best as possible for you. We understand, like I said earlier, it's probably the biggest investment you're going to make in your lifetime. So it's a big deal, but we'll get you to that finish line and get to step 6 in the process for sure. I'm going to transition to our final stages here in just a second, but I did have a question that came in, and the question is, what are your thoughts on getting a 2 to 4 plex, so a 2 to 4 unit property as a first-time buyer and living in one unit? So not a bad strategy if it works for you. The only challenge that I see for first-time buyers doing that, a couple things. One is you won't be eligible for first-time buyer programs because first-time buyer programs only allow 1 unit properties. Secondly, if you're using a conventional product, you're going to have to put 20 to 25% down to purchase that home. You can look potentially at an FHA loan, which has a 3.5% down payment requirement, but we just would have to see if that makes sense for you financially. Okay. Another question came in. Can you buy short sale homes with loan assistance programs? Absolutely. You can also buy foreclosed homes, so that's not a problem at all. And another question is, can you discuss or clarify the differences between what your team does versus what a realtor does during the home buying process? Great question. So when it comes to the financing side, that's where our team is involved. So designing interest rates, the payments, actually providing the financing, the funds that you need to purchase your home. Whereas your realtor is going to be more so on, what's the quality of the property look like? Does it meet all the characteristics that you're looking for? How do the inspections look on the house? How is my negotiating going with the seller? Is there things that I need to get figured out? Maybe it's a sewer repair item. So things that has to do with the actual property will be more in the realtor space. More on the financing money side of things would be on the lending side, which was what our team would take care of. Okay, so we've heard me talk a little bit about consultations. I think that's a great next step for some of our participants in tonight's workshop, if that does work for you. And that's just where you get a chance to design a home buying plan for you. Usually what that will entail is an online application. We do a soft credit score for you. You'll upload some documents, and then we meet over video one-on-one with me to design that plan. And I think that's a great way of just putting together some goals, objectives for what home buying could look like for you. You don't have to buy this month. It doesn't have to be next year, but at least you kind of have a plan or framework in place for home buying. Now, if you have some questions that didn't get answered on tonight's session, we can schedule an introductory call. Maybe there's like more of a personal situation you want to go through financially and kind of walk through it together. We'd love to connect with you for that. To connect with us for any one of those sessions, you can click here to schedule an appointment. Usually our introductory calls are 15 minutes and our consultations are only like 30 minutes, but that's a free service we provide to our clients. And here's the framework of a consultation. So it's budgeting, it's going through the steps of home buying, it's taking a look at credit, location of where you want to purchase, talking about interest rate options to make sure you have all the information to make a good, sound decision. And Ken just shared with you in the chat a little bit more about how to schedule those sessions with us. Here's our mobile app. This is a great resource. I forgot to talk to you a little bit about it earlier. This will allow you to do payment calculations, I should say. You can apply right on the mobile app. You can follow the progress going through the 6 steps of home buying, all right through mobile. You can even chat with us as you're going through the home buying experience. And we have some fantastic community partnerships through different universities in California and other states. We're proud to be able to bring these workshops to some of those alumni communities. If you've attended one of these universities, or maybe even you're a state employee, we do have discounts of up to $750 on your closing costs. Again, consultations that we do are free services to help to build a home buying plan. And we just want to be your trusted mortgage advisor in the process. So, and that's why we bring these educational sessions to you, because we want to help, invest in your financial future in sustainable and affordable home ownership. Here's some of our upcoming classes. I know we're going to start getting into the holiday months here soon, but we're still going to have 3 more classes, I should say. One more for Southern California, one for the Bay Area and Sacramento. So if you have friends, family, maybe some coworkers that could really use some information like this to prepare for 2023, we'd love to have you invite them to one of these classes. They can go to Mortgage Educate to learn a little bit more about those classes. Here's all my contact information. So if you want to get connected with us after tonight's session, feel free to reach out. You can schedule an appointment for an intro call, maybe a consultation. And we love what our clients are saying about us and some of our reviews online, and just some of the, the testimonials that we hear and their experiences in home buying, because it's a big deal to purchase a home, and to, hear what our clients are saying about us and their experiences really means a lot to us. And a lot of which are some of our graduates from these classes. And there's a lot of information coming out in the market, especially with, forthcoming information on the California Dream for All program and just things in the market, whether it's rate driven or housing market. So we would encourage you to connect with us on our social channels. We're really trying to do a good job of posting videos, and our stories and just updates overall on what the market is doing, especially with the California Dream product. I'll be posting stuff on our Instagram. So we encourage you to follow us on some of those channels. Other than that, I'm going to go ahead and leave the lines open so we can kind of talk a little bit more about any questions you have. I really do appreciate all of you joining us tonight. Hopefully this information was informative for you, and we'll hopefully get a chance to connect with you for a consultation soon. So let me go ahead and keep the lines open, and feel free to ask any questions that you have that didn't get already answered for you. Anybody have any questions out there? And we had some good questions throughout the night, so maybe you guys got all the information you needed. Okay, we had a question just pop in. So the question is, are you able to assist with loans for modular or manufactured homes that we need to purchase the home and land for about the same time? So unfortunately, we don't offer those programs. It's a little more challenging when you're trying to purchase that type of property, because you do have to get financing for just the land, and then you have to get separate financing for the manufactured home. So it's a little challenging. There is special lenders that do that. Not sure who is offering that out there in the marketplace. Another question is, how much does student loans impact your ability to buy? You know, it really just depends on everyone's situation. Sometimes it's pretty significant. Sometimes it's very minimal. Hopefully, you know, you're on an income-based repayment amount, because that's going to give us the lesser amount of payment and hopefully make things a little bit more affordable for you. Another question came in: at what point do the My Home Assistance funds become available directly with and through the signing of the mortgage document? So the way the process works, if we were to go back to the 6 steps of home buying, so when you get pre-approved with us, that means we have you qualified for the program based upon your eligibility. Once you have an accepted offer, we then register you with the state. Your funds are reserved at that time, and then we lock in your interest rate. So the interest rates on those programs are all set by the state of California. So, and by registering and locking in, that reserves your funds. That's especially important on the Equity Builder program, because as I mentioned, there's limited funds right now. So we have about 90 days of runtime on that program. So if you're interested in that program, I really encourage you, you know, hopefully get pre-approved right away, but also maybe take a look at home sooner than later, because those funds are moving or going down pretty quickly. And by the way, there's a second part to this question. So the funds, when do the funds become available? I just was looking back at that question. So we fund the loan. When we fund the loan at step 6, the first mortgage, we also fund the My Home Assistance. So the 3% or the 3.5%. So that all gets funded at step 6. Okay, any other questions out there from our audience? You're very welcome. Thank you for going to the workshop. Okay. All right. I think we've gotten to the end. I'm a little bit over our time that we usually allocate for tonight's class. So again, if you have any follow-up questions, please feel free to reach out to us. If you do have some questions, we'd love to be able to get connected with you for a consultation. And like I said, encourage you to maybe follow us on some of our social channels to kind of get some latest updates on what's going on with some of the market and some of those first-time buyer programs. Okay. Have a good night, everyone. We'll look forward to talking.